Joseph Trevisani from Worldwide Markets. We will start in about a minute. I think I just fixed the sound. Well, that's a first. Well, why don't we start? Good day, everyone. This is Joseph Trevisani of Worldwide Markets. Today's topic is ECB, quantitative easing ECB style, which is mostly an attention getter because, oh, by the way, a couple of notes. Good afternoon, good morning, and good evening, wherever you are in the world. It's nice to hear from you. I like doing my webinars as colloquiums. If you have anything to say, whatever the topic, please chime in, come in on chat, or come in on questions. Let me put the questions up so we can see them, and I will be glad to stop and discuss whatever you have on your mind. It does not have to be specifically on our topic. Almost anything having to do with the markets will be fine. So let us commence. The Europeans, back in January 25th, started their long sought after Mr. Mario Draghi's great achievement, quantitative easing. Given the success of quantitative easing over the past, and its various permutations over the past generation, one has to ask why this took place, what they hope to accomplish, and how they're going to accomplish it. But in the meantime, let's take this step by step and look at what it is they're actually doing. Where did I write that down? Hang on. And what their goals are. And then we're going to look at some of the comparisons, of which there are now two substantial ones. Where did I write that down? Out in the world. Hang on. Sorry, folks. That's very peculiar. Anyway, I think I wrote it down in my other notebook, which I'm going to have to go without it. Okay. Okay, let me deal with that first. Yes, I did see a note about 2 weeks ago that the New York Fed had set up a subsidiary, I guess, bond trading desk in Chicago. Disaster preparedness, I guess. Nobody really said very much. In case we have another hurricane and we flood New York, it's quite possible. I mean, the 2-year hurricane 2 years ago, I mean, there were 8 feet of water in downtown New York, and that flooded almost everything there. And the Fed is right in downtown New York. I don't know how it was affected, but that's the reason for that, I think. As far as the New York Fed and J.P. Morgan being underground by a tunnel, my guess is, if there is one, I certainly don't know one way or the other, but if there is one, it is not for any nefarious purpose. I mean, what would be the need for that? Much of Lower Manhattan is old. The underground structure there is incredibly complicated, and there are basically tunnels and steam pipes and access points and train tracks throughout much of Manhattan and certainly through downtown Manhattan. So whatever's going on down there, I don't know. I think I read that item on Zero Hedge, which is sort of the Armageddonist collection point for economic news. It's a very good website, and it's a good antidote to a lot of the boosterish stuff you get from Wall Street as far as equities go. A good example of that is today. GDP came out at 0.2%. The most accurate prediction was the Atlanta Fed GDP Now, which I recommend that you all look at. It is a rolling estimate of American GDP, which incorporates statistics as they come out, and its prediction was 0.1, and it has been dropping steadily throughout the first quarter of this year, and very accurately. Okay, let's move on now. So the ECB announced back in January, starting in March, that they were going to buy 60 billion euro a month. We've all heard this. We all know what it is, in various types of private and public debt. They are not going to buy debt with an interest rate lower than their own, which is negative 0.2%. And they've started. So let's look at the ECB balance sheet. Here we go. This is the ECB balance sheet. Guess what? It shoots right up from 2150. So they bought 200 billion or so in March and April. Okay, you'd think they have a little bit more. Now, they had some trouble finding enough to buy. Nevertheless, so they are commencing. So what are the purposes of this? The ostensible purpose for all of the quantitative easing that has been enacted since the financial crisis has been to head off deflation. Remember, the monetarists in some ways are like the Keynesians in that they look to manipulate the markets. The Keynesians more for the markets, the monetarists more for the money supply to get action out of the economy. The great bête noire of the Keynesians since the financial crisis has been a lack of demand. Exhibited, they say, in the deflationary impulses coursing through the world economy. And there's no doubt that there's deflationary interest looking through let's see if I have a long enough chart. I don't think that I brought up a long enough, because that's not really on my topic, of the deflationary impulse in the world economy. So, first off, their concern is to head off deflation. And if you look at the year-on-year CPI out of the EMU, what do we have? We certainly have a lessening of inflation. But this trend, which I only have about here, going back to 2009, is a deep historical one. And it's not only true of Europe, it's true around the world. Inflation has been declining uniformly for the past generation. Now, there is a double logic to this and to what they're doing. They are saying that the deflationary impulse is one which can be thwarted, and two, it is not essentially tied to that historical movement down in interest rates. Let me see if I have one. I have some charts from last time. No, I don't have it. That's Japan. Okay. So, but if you look at deflation in the United States, and I didn't want to put this in too great of a historical sense. So the movement down in inflation rates, which the central banks in the world are all trying to fight with quantitative easing, pumping up the money supply. So in a way, they're taking a page from the monetarists, saying, the problem is the money supply, so pump up the money supply, and you will get enough liquidity out there with the same amount of demand to pump up inflation. What have we seen? Okay, so that's one side of what they're doing. And that is sort of the theoretical side. Deflation equals bad. Why do we say deflation is bad? In many ways, the world that we're entering in now, economically and financially, is a different world. It has many reasons, I think, that are behind it. But the assumption that deflation is necessarily bad is not necessarily one that everybody shares, but the people all in power share it. People in positions of financial power, meaning the central banks. From historically, if you look at prices historically, I don't mean historically as in 5 years ago. I mean over several hundred years. Until largely, not entirely, with specific examples of inflation and hyperinflation caused by specific actions of governments. But if you look at the price of, say, wheat, which has a very long historical record in Britain, for hundreds of years, the price barely fluctuated. It didn't move very much. Inflation is as a general item in the world's financial picture, is largely a creation of central banks, who then assume control of the money supply and start viewing the money supply as a criteria to be manipulated to gain economic effect. The settled idea that deflation is always bad is based on, of course, two things. The reaction of prices in the Depression, when prices did fall. But I mean, if you look at prices right here, this early part right here, prices collapsed during the financial crisis. What happened? Well, people stopped buying stuff because they were worried. And the stores all had their inventory. And to get rid of the inventory, which cost them to maintain, they cut prices. They took losses, cut prices, got the stuff off the shelves, started over. Temporary phenomenon. The theory behind it is that deflation will induce people to postpone their purchases. I personally have my doubts about this as a consumer. If I want to buy, and I did, one of my cars does not have a digital hookup, so I have to buy CDs for it. And I wanted something by a particular artist, so I went out and bought a CD. Now, if I was in the grip of a deflationary mindset, would I have postponed 2 weeks? No. So I don't think it has near the fact. But take a big ticket item, which is something you might. If you're going to buy a car, probably the second largest purchase that most people make, the first being their house, at least here in the States. Would I put that off 6 months? Yes, you might. So there is some logic to it from a consumer point of view, that deflation retards prices, retards purchases. But the problem with it is if you have long-term deflation, there still has to be an equilibrium price moment where demand equals prices. Prices, after all, can't go down forever. Famous line, whatever can't go on forever won't. Same with prices. So I think the impact that deflation has, and I'm not an economist, so I don't have a lot of fancy theories and equations to prove this, because it backs up into the trader's mentality of judging markets, judging people who don't, as we've seen, necessarily respond the way theories expect them to do. So the first threat that central bankers see, or the prime threat that central bankers see, is deflation, and deflation countering or adding to, augmenting an already weak economy from either a business cycle on the downside, or as we've seen right here, a balance sheet recession, which is what this is called. So that's the first thing. They want to stop deflation. And there's no question, if you look at this chart, that there is a deflationary impulse, at least a lowering prices, disinflationary in Europe. The Fed, I'm going to talk about the Fed in a minute. Let me finish with the general. And the second, of course, is to promote economic growth on the theory that lower interest rates, because after all, what the central banks do, everybody's got their main interest rate at the zero bound already. So you can't lower rates anymore. And so Mr. Bernanke came up with the idea of, well, let's go. And it's not the first time this has happened. The Fed has done stuff like this before, but nothing on this scale. Let's go buy bonds. Well, if we buy bonds, what does it do? It forces down interest rates across the board. And it forces down interest rates that, and here's a I did I send that over? I think I did. I have something for the U.S. 10-year. I think I have, wait a minute. I think I have one. Let me just check. Here we go, this one. Now, this one goes back, and it's only updated to the end of the year, but these are the various QE dates, and you can certainly see Well, this is the euro. The effect that it had on the euro. No, I didn't bring the one with the 10-year. You know, there's so many charts that you can use for a presentation like this that you have to be a little circumspect. I can't bring every single chart because I'd never get done, and I tend to get overstated anyway. Okay, so let me go back to this. This is the second purpose, to sponsor economic growth, on the theory that economic growth will be aided, at least temporarily, by low interest rates. That, of course, is the counter-cyclical argument from central bank monetary policy. That when things are going well, you worry about it overheating. When things are starting to slow down, and so you raise rates when things are starting to slow down, you worry about a recession and a deeper recession, and so you lower rates. The key, so we have the setup for what quantitative easing is hoping to do. The Europeans have their restrictions. They may actually have a difficulty. You know, it's interesting. The biggest economy in Europe is Germany, of course. Germany is running a surplus in government. What does that mean? Well, it means they don't have to issue any bonds. Not like the U.S., which is running, between $500 billion and $1 trillion in deficits. So we have to issue tons and tons of bonds, which keeps the market well stocked with things for bond traders to buy and banks to use as collateral and to buy and use as collateral. In Germany, they are not issuing bonds because they have a surplus in the budget. And so Europe is going to start running short of bonds to buy. Okay, so let's look at the effects. So it's easy to say. So is the idea of deflation being fought by issuing liquidity a sensible one, or at least one which is likely to have the effect that the central bankers want? And in this case, I would probably say yes. Central banks cannot create growth. They can help and aid the conditions for it, but they do have a fair amount of control over the money supply and how prices relate to the money supply. Now, the interesting thing in the United States is that Mr. Bernanke and the others, Janet Yellen now, especially in the beginning when QE started, were discussing quite at length the deflationary impulse in the United States economy. And I'm going back to the United States right here because the intellectual background for what the central banks are doing, including, of course, Mario Draghi and the ECB, came from here, came from the Fed in the United States. And Mr. Bernanke's studies of the Depression and the deflationary price impulse in the Depression. But the interesting thing, the thing which I always found interesting about the Fed's focus on inflation was, these webinars are recorded and they are posted on the FX Street site, and I'm told they're reasonably popular. I think my whole family does not go to listen. But my girls do like to hear my voice in recording. I don't know why. It's kind of funny. They're young. Anyway, yes, so they are recorded. The interesting thing about the Fed and the Fed's approach, when they first started justifying their quantitative easing program, they were foursquare focused on deflation. Yet, the Fed's own measure, their own preferred measure, the PCE, I apologize. Being an American, my linguistic skills are rather limited. I was reasonably fluent in wrong webinar. Okay. Well, sorry about that. Maybe you'll find it interesting. Anyway, so the Fed's focus in the early days of quantitative easing was on deflation. Yet, at that time and still, they talk about inflation needing to get to the 2%, to head towards the 2%. But if you look at their preferred measure, the PCE core deflator, it never strayed very far. Even now, I think it's 1.6% a year. How far is that from 2% that you need this massive, I think it is, yes, but I'm not sure, that you need this massive quantitative easing. So even in the logic of the Fed's original item, as far as focusing on deflation, there was a logical gap, shall we say. So it's clear that in the beginning for the Fed, they may have spoken about deflation because deflation was something that almost everyone agreed the Fed could do something about this monetary policy. The idea that quantitative easing would promote economic growth was, shall we say, unproven. It is now largely proven that it does not. It does not create normal economic growth, depending on what you mean by normal. What we've seen since the financial crash in the United States, the end of the recession, and the advent of quantitative easing, is that it really hasn't had much effect on economic growth whatsoever. The economic growth before, economic growth during, and the economic growth after quantitative easing in the United States seems to be the same. We are in the same 2.5% range that we have been in for 6 years now. This is an unusual occurrence. In addition, it has not affected the consumer side, the great Keynesian demand side whatsoever. It hasn't created demand which would create business investment, which then creates jobs, which then get paid, and you have the upcycle that everyone's looking for. So, back to the ECB. So, the deflationary impulse is one thing, and then there is the economic growth conundrum, which is another. Both of these are the source, the logical source for, or the theoretical justification for quantitative easing. So now we have the ECB. And the ECB is doing the same thing. Okay, so first off, let's look at some of the statistics and see what kind of fact. Now we know from the United States, and I didn't bring a whole raft of United States statistics because this is specifically about the ECB. But let's look at the first one. This is this is just a chart of ECB assets, the balance sheet. And guess what? They started buying in March, and okay, great. That means they started buying. That's not telling us very much. Now, I'm going to go back to this in a minute. This is a chart of GDP annualized for the EU, the EMU, the United States, and Japan. Okay? The U.S. is yellow, the EU is green, and Japan is white. The reason it's here is because Japan, I'm going to use after we go through the current effects on European GDP, on European sentiment, and some of the other figures. I want to look at the comparison for, we do have two examples historically about quantitative easing. Japan goes back 25 years. And currently. But let's look at some of the, and then we have the United States as well. Okay, so let's look at the most obvious effect of quantitative easing in, and I think so far at least, the only positive effect, it's early yet, of course, of European GDP. I mean, on European on currencies. So far, we can look at the white line here is the euro. These are all in currency terms. So this is the value of each currency. It's not like it, I have up here the dollar. I have the Swiss, but it's not the dollar Swiss. It's the value of the Swiss franc, the Polish zloty, the Hungarian forint. Red is the sterling, and that's the Romanian leu, L-E-U. So one thing that we've seen, that quantitative easing reduces the value of the currency. This is certainly something that the ECB wanted. It is something that has happened. And, I mean, part of it is because you're going in two directions. But a good reason, a good portion of the change is due to the ECB's own deliberate policies. The line here is January 2nd, when they, January 22nd, when they announced, when Mr. Draghi announced the ECB policy. But, of course, the anticipation for this had been building for many, many months, certainly since the summer. So, as far as the currency effect goes, it's real. It's strong. It's over 20% for the euro. How much of an effect this has back on the European economies is debatable. And you could say, well, the currency is down 20%. Why wouldn't it have a large effect on European manufacturing and perhaps even European services? And well, the answer is quite simple. Most European trade is with other people, other Europeans. Therefore, it doesn't have any effect at all. It will affect, and in fact, you could say that inter-European, it will have a negative effect on business. Because, I mean, what is one of the outside effects of a weaker currency? Well, all those raw materials that the Germans have to buy to make cars, machine tools, any of them outside the EU, those items are all more expensive when the currency is weaker. So yes, although it is true that France can sell more Peugeots and Germans can sell more BMWs and Mercedes overseas outside of the EU, and that will help their trade balance and supposedly help the economies, help jobs and things like that. Those cars themselves will have an upward price pressure from the rise in commodities. Now, another thing that's true, though, and this counteracts that as well to some degree, that since the commodity prices are all lower, because one of the main the dollar got considerably stronger, and as the dollar gets stronger, the prices of most commodities go down. So there's a balance here that is hard to strike just in words. You have to do it in numbers. By and large, though, and overall, I would say that as far as external trade balances go, the lower currency is a asset to European manufacturers and perhaps to the European economy as a whole. But what have you seen here? If you look at these other currencies, the Swiss, the zloty, the forint, the cable, and the leu, and except for the cable, they are all down a commensurate amount with the euro. So as far as the near, as the Russians call it, the near abroad for the EMU, there isn't a lot of effect on the currencies because they've come down. There isn't going to be a lot of effect on their trade. For the British, yes. For the Americans, yes. So that effect, let me answer that question. My guess is he does have a target in mind for the euro. My guess it is somewhere between 105 and 110. He's not going to say that he has a target, and he's certainly not going to name a target. But my guess is, yes, they do have had a target for that currency. But as I said, they're not going to say it. Okay, so the first effect has been currencies. Now, this is twofold. There's the economic effect, which I just spoke about, and of course, there's the anti-deflationary effect. The The European Central Bank targets headline inflation, which includes energy and food prices, which I think is a sensible measure of inflation on its effect on the economies, because after all, you and I and everyone else pays those prices. We all have to eat. We all have to fuel our automobiles or motorcycles or mopeds, whatever we ride around on. When I was in Bermuda, I had a French Peugeot scooter, which the thing was great. It just started up every single time, got me home always, never had any problems with it. Unpaid promotion for French vehicle manufacturing. So it has its effect on inflation as well, because as the prices of things rise, because the currency's worth less in imports into the EU, that also counters deflation. So from the monetarist point of view and from the deflationary point of view, the EMU can probably look forward and has looked forward to a reasonable amount of success. So let's take a look at the EMU CPI monthly. And here we go. I believe this is the January number and this is the March number. Okay? So there we go. But the thing is, there's a pattern to this chart, which doesn't seem to have anything to do with quantitative easing. I'm not sure what created this pattern. I noticed it when I put up the chart, but I did not investigate what it is. But if you look at this, we have a price spike in the beginning of every single year. Well, not every year, but every year that's on this chart. 2010, 2011, 2012, 2013, 14, and 15. That requires an explanation. So we can't quite look at this chart and say, okay, the month-to-month reason, the month-to-month GD, the month-to-month inflation, CPI numbers are getting a real boost from quantitative easing. Mr. Draghi can go home and have an extra aperitif when he has his dinner. Okay, let's look now at the year-on-year CPI, and we see a similar thing here. Okay, now part of this is base effect, as with all European, all year-to-year, because we're looking at the beginning of here, prices were falling, so you have a little bit of a base effect, but still, we have the effect that Mr. Draghi, perhaps, we have the effect that Mr. Draghi is looking for as far as prices go. Another factor here is that oil prices have started to go back up. They haven't gone up anywhere near they were, and I don't think they will. But they were down at 43 briefly, and now they're trading around 56. It's around a 25% rise in prices from the 43 base. That's a pretty substantial price. When I bought gas yesterday, I think I was paying $2.35 a gallon here in New Jersey, which is where our office is, and not long ago that had been $1.99. So it's a pretty substantial increase. And that has nothing whatsoever to do with European quantitative easing. Okay, now just a note on that. The number of U.S. shale oil wells that have been either idled or not completed, pending a rise back in prices, will probably keep a cap on oil, I would say, below 70 for the near future, and I would say the next 2-3 years. And I'm extending myself on this one, because anytime the oil price starts to go up, those wells can be brought back into production and capped as far as the price goes. Okay, so for the Europeans, as with the Americans, the quantitative easing program has had its effect on inflation, at least temporarily. So let us think for a moment about what is behind the inflationary impulse or lack of such, and whether it can be addressed. One of the things we must remember, and I know I mentioned this in almost every webinar where I talk about central banks, is that central banks have been viewed ever since Alan Greenspan, who helped to promote this idea, as the great custodians of economic health, the savants of the financial world, whose knowledge, expertise, theory, and tools have enabled them to quell inflation, which it has, and to promote economic growth and well-being. The habit of control, of intervention, has been growing on the part of central banks very steadily for the past 20 years. World economically, and what do we have? Four economic areas, which together are probably, I don't know what the figure is, but probably 90%, probably 80% of world GDP. I'm not really sure what the number is. United States, European Monetary Union, Japan, and China. Might be 90%, I'm not sure. All pursuing the same economic policies. Bond purchases, quantitative easing. The purpose, we talked about it, one, to fight deflation. The Chinese have the same problem. The Japanese have had it for 30 years. And the other is to promote economic growth. Let's look at some more European statistics before we move on to the theory of what we're doing here, okay? Okay, that's the one I'm going to keep up. Okay, so this is European sentiment of various types. I wrote down all of these so I can tell you what they are, because the cues there don't give you very much. Okay, the white line is market economics. It's a London-based survey firm. It's their composite for European sentiment. The yellow is Centex, same thing. The green is the German base, but this is the European survey. Economic expectations. The next three are from the EU Commission. Purple is industrial confidence, red is consumer confidence, and orange is economic confidence. So what do we find? Now remember, these are sentiment numbers. They're not actual production numbers. European production numbers have hardly changed, and I didn't really bring very many. And the main reason is because you're going to see, we just have too many charts, but also it takes a long time for these kinds of policies to have their effect. And they only really started buying in March, which is last month. And they only announced the policy back in January. So there really wasn't any appreciable effect yet on the economies in Europe. But you can see that the sentiment numbers, they've all blossomed. Everybody seems to be happy. Everyone is expecting some sort of benefit. Now, what kind of benefit is not isolated by these figures? But clearly European sentiment, both among consumers and amongst business people, is stronger. Let's look at another level. This, of course, is the other great effect of quantitative easings policies. One, it downs your currency. Two, it boosts your equities. The United States, I mean, we had a terrible GDP number today. 0.1, 0.2. Dow was only off 50 points when I came in here. Nothing. It is looking like the second quarter is not going to be greatly improved. Nevertheless, the Dow is close to all-time highs. That's exactly what's going on here as well. Now, the benefit to this, to the economy, of course, is the wealth effect from, well, the ostensible wealth effect, the theoretical wealth effect. People feel wealthier, The stock market is higher. After all, when you practice financial repression, you can't get a return on anything. Therefore, you look, let me see if there are any, therefore you look for alternative returns. It was in the beginning, although we stopped talking about it, one of Mr. Bernanke's stated goals. In my mind, it is a false hope. We have certainly seen in the United States, and I'll talk about this in a minute, that higher equities don't do a great deal for the economy. It certainly doesn't do a great deal for spending, and it doesn't create jobs. Nevertheless, you can look, and Mr. Draghi, I'm sure, and his colleagues look at this chart along with the euro, and they say, this is a start. We are having the effect that we want. The problem, of course, is that it is a market effect. The focus of quantitative easing is primarily markets. Financial markets, credit markets, equity markets, currency markets. The planners and executors of this policy hope that those markets will then have a balm, will act as a balm, a beneficence on the real economy. Because after all, jobs for most people are not tied to finance. They're not tied to currencies. They're not tied to equities. They're tied to the factory or the office down the street or in the next town where they live. That's where the jobs come from. The jobs are tied. In New York, no. Manhattan, where I live, they're tied to finance. But everywhere else in the country, they're tied to the real economy. And the best that this policy can have is a effect it wants remove on the economy. Okay. Let's see if European business loan. This is European business loan demand. Another thing low rates can't do is create demand. We've had low rates in the United States for a long time, 6 years. It does not create demand. The economy creates demand. Sales create demand. And we can see that right here. These numbers aren't updated because they're very slow coming out of the European Central Bank. This is only the February number. But January 22nd was the announcement for quantitative easing in Europe. There's been no appreciable. I did hear a figure recently that demand had gone back up in March. I couldn't find the figure, so I didn't bring it along. I couldn't find it. Okay, so we have a 45-minute webinar today, so I'm going to have to end in about 2 minutes. So let me survey what we've done here and what we're talking about, and then look a little bit at the future. Quantitative easing's effect in Europe. Well, let's go back right here. Let me just make one other comment here, since we're talking. So what can we expect now that the Europeans have started quantitative easing? Mr. Draghi has his wish. Well, we got a lower euro. We got higher equities. We're going to have lower rates in Europe. Oh, the other one, let me put this one up. This is, in my mind, the most bizarre. Where is that? My favorite one. The 10-year rate. Didn't I bring that? Oh, yes, I did. Here it is. This is the European. There's a great column in the UK Telegraph today. You can find it on Real Clear Markets by Jeremy Warner about negative interest rates. These are the 2-year notes in Europe. Germany is white. Switzerland is red. France is yellow. Spain is green. And I believe Italy is purple. Something like 30% of all outstanding European government debt now offers negative interest rates. This is not a situation that should give anyone a great deal of confidence. What does it mean? It means, and of course, quantitative easing is pushing this along. But these rates were headed lower long before quantitative easing. What is it saying? It is saying that investors are worried enough about the future so that they are willing to take a small loss on their principal. Now, in a place like Switzerland, you can say that that is offset by a stronger currency, so maybe they end up neutral, depending on when they decide to take it out. But negative interest rates, which is where the world is headed in general, are not a sign of a healthy economy. So let me just wrap up with this so we know where we are. This is the ultimate goal. The purpose of all quantitative easing is to tie, and all bank policy since the financial crash, is to tide over the economies until they resume natural growth. Well, look at the white line on this GDP chart. Japan has been practicing quantitative easing, and the other side of it, government spending from almost a generation. The worst performing industrial nation, advanced industrial nation, over the past generation is Japan. Quantitative easing may be the only tool that economists or bankers and economists have or think they have to address these economic issues. But if there's anything I think that's clear, and I think we're going to see this in Europe as well, quantitative easing is not going to provide the economic growth that the Europeans desperately need and desperately say they want. It did not work in Japan. It has not worked in the United States. As a tool and as a theory, it seems to me that it is inadequate because what it does, remember where economic growth, and that's the goal, that's the holy grail for all of these policies. Where does economic growth come from? How is it generated? It is generated, certainly here in the United States, from the small company. It's the companies that start and most fail. But the ones that succeed create jobs, create income, create wealth. If the policy of quantitative easing serves to retard that creation, and it is my mind that it does. How much? It's very difficult to tell. It does because it misallocates the chief resource of capitalism, which is capital. If you do that, then you necessarily damage economic growth. So in my mind, the compulsion almost of central bankers to act has gone so far that it is actually part of the problem, I think. One thing that we know of capitalism as a system, and this is after all what we're talking about, is it requires constant internal renewal. I think what is Hayek called it, creative destruction, I believe. It is necessary that it purge itself over and over again as part of the creation of wealth and the creation of growth. And if that process is inhibited, then the policies are part of the problem. Okay, folks, I thank you very much for attending. I know I ran over a little bit as I do. I hope this was interesting. So, as far as what you're looking forward to, keep a watch on European statistics. I imagine you will end up with something as you get here in the United States. Not very much improvement. Okay, thank you very much for attending. I will put my email address up there. If anyone has any questions, comments, considerations, or any jokes they'd like me to tell, or any topics that they would like me to cover in my next webinar or my next several webinars, please let me know. I will suggest them to the wonderful people at FX Street. Adinda, I'd like to thank you very much. Adinda, I believe, is in Indonesia. An interesting world we live in. Again, thank you all very much for attending, and I hope you have a great day. Take care.